Well, it is monthly Q&A time here again on the channel. I put up a community post here on YouTube a couple of days ago to collect your questions for this video, so thanks to everyone who did ask a question. If you want to get a question potentially in a future Q&A video, just keep an eye on my community posts page here on YouTube. You should be able to turn notifications on so that you're notified every time I put up a new community post or post a new video, and that's where I always collect the questions for these monthly Q&As. So that is the plan for today's video. I'll go through a mix of some of the people who got in there really early and asked questions basically straight after posting, and I'll also go through some of the most top rated, kind of most thumbs up questions as well. But before we get into that, we do have a sponsor for today's video, and this video is sponsored by Hatch. Hatch is the platform I personally use for all of my US investing for me as a Kiwi based here in New Zealand. And Hatch is asking you to think about what your big and small tomorrow goals look like. For me, the goal has always been financial freedom, putting a little bit away today with the aim being that I can do the things that I want to do tomorrow. Everyone's tomorrow looks different, whether you want to buy your ultimate dream car, travel the world, or become financially independent. Reaching your goals starts by taking the first step. That's why I invest with Hatch, to help make my plans a reality. And if you want to get started investing with Hatch, check out the first link in the description where you can get a free 20 New Zealand dollar top up when you make your first deposit of 100 New Zealand dollars or more before the 31st of December 2022. Okay, let's start off with a nice easy question here from Luis. In a world of TikTok and same-day Amazon delivery, we actually don't have Amazon same-day delivery in New Zealand. I believe Australia has Amazon and we can order stuff from Amazon in Australia and the US. I've done that with books and stuff before, but as far as I'm aware, at least, we don't have same-day Amazon delivery in New Zealand. But anyhow, that's probably besides the point of your question. In a world of TikTok and same-day Amazon delivery, do you feel younger generations are being set up to fail at investing, which requires patience and delayed gratification? Or do you feel the current challenges are nothing new, or perhaps that younger investors have advantages that give you more optimism than concern? Yeah, I think there's definitely things in place that are making people more short-term minded and maybe making delayed gratification more difficult. I think it's probably an ongoing progression of what's happened in the past, though. Like, I'm sure when people went from sending letters and having to wait for some pen pal to reply to them, and then they upgraded to the telephone, that was probably quite a big game changer as well. So I tend to think that technology just kind of like reinforces and maybe like enhances your existing personality, I would say. So if you're already a patient person or an impatient person, I think technology can potentially make that better or worse. So yeah, we live in a world, from an investing perspective at least, where delayed gratification is very useful, and I think there'll still be people out there that have that and can be rewarded. So that's my thoughts on that. Next one is from Khaled. Hi Tom, love your content and a religious follower too. Thank you very much. I was in your neighborhood for work recently. It was great to be in NZ. Very cool. Hope you enjoyed it. Question, do you continue to hold great businesses in depressed times or sell to relocate resources to even better opportunities? Cash is not easy to come by in these high inflation periods. Thanking you. Yeah, sure. I guess I don't know about yeah, I suppose cash not easy to come by in high inflation periods. Yeah, I guess people's bills are higher. That's that sort of stuff. But hopefully you've got your life kind of structured in a way to where you're not overextending yourself, in good times when making investments, and you've still got a little bit of firepower to do stuff when things do get a little rougher. In terms of your underlying question, do you continue to hold great businesses or sell to reallocate resources? Right now, I'm sort of in a position where if I want to buy stuff, I've generally got cash coming in, which is like reasonably significant each year relative to my current stock portfolio. So if I do want to buy something, I don't usually have to sell anything. But I would be pretty hesitant to sell, good businesses at depressed prices. I think it does really just depend on the opportunity set. Like if you have to sell a good business at a low price to buy a better business at an even lower price, then that can definitely make sense. But yeah, try to be a little hesitant to sell if I can possibly be. So thanks for your question. Next one is from Marwian. Hi Tom, did you look for, and if so, have you found other companies which follow the concept of scale economies shared besides Costco, Amazon, and ASOS? Yeah, the short answer really is no. I think a lot of those companies are pretty rare beasts, Costco, Amazon, and ASOS, but if anyone can stumble across one, definitely let me know. I think we're seeing recently, particularly with ASOS, that you really need that very strong business model and good management. You know, ASOS has been without a CEO for a little while. My understanding is the new incoming CEO actually wants to change up that scale economy shared model a little bit and focus a bit more on shorter term profitability. So not quite sure how I feel about that. I've never owned any of those 3 businesses that you mentioned actually, but if I stumble across one of these scale economy shared businesses, it will be a great day. So thanks for your question. Next one is from Kanav. Can you break down your Hingham purchase? Yeah, sure. I guess anytime I talk about an individual stock, do your own work on it, take everything with a grain of salt. But the basic, theory behind the Hingham purchase, it's a modest, very modest position for me at the moment. I'll grow it, I think, if the price goes down. But it's essentially a very simple and very well-managed bank. I mean, I can get my head around it because it's simple, and, banks can be very good businesses if they're well-managed. And I think that's kind of the setup you've got at Hingham. Hingham is sort of a liability-sensitive bank, which basically means as interest rates go up, they tend to have to pay out money relatively quickly on the deposits that people have, sitting in savings accounts and so on. And it takes a little bit longer for them to get those higher interest rates coming in the door on the asset side, on the loans that they've got. So quickly rising interest rates can be a bit of a headwind for something like Hingham. The absolute level of interest rate doesn't really matter too much. It's more the rate of change. So if they're going up or going down very quickly, that significantly impacts Hingham's business. So if interest rates rise quickly, that's a little bit of a headwind, although they still seem to be growing book value at like 10% a year, annualized even in the current conditions, which I think is quite good. And if interest rates ever drop sharply, they'll get a great benefit from that, kind of like they did in 2020. So I think the market probably doesn't like the sharp rise in interest rates we've seen recently. It'll probably be a short-term headwind for Hingham, but potential long-term opportunity is kind of how I'm viewing it. But again, please do your own work on the company. Next one is from Daraj. Hey Tom, do you think that instead of just holding a broad basket of US equities, if you bought the top 50 companies from all around the globe which had the highest return on equity or return on invested capital and low debt and operated in Western democracies, do you think that would outperform the S&P? Because I think it was Munger that said over time, if a company survives, your return and the return on invested capital are more or less the same. Sorry if the question's a bit long. No, all good. That is a very good question, and I would highly recommend picking up a copy of The Acquirer's Multiple by Toby Carlisle, because it goes through this exact question in a lot of detail. And the short answer is that, Toby Carlisle looked at the magic formula from Joel Greenblatt, which takes the best return on capital businesses, that are also trading at reasonable prices. It sort of ranks companies on both of those metrics and tries to get the best mix. He compared that against basically completely ditching the return on invested capital metric and picking a basket of stocks based purely on price. And the ones that performed best was actually the one where you threw the return on invested capital metric out the window. So it seems like that actually potentially detracted from returns, but there's data throughout that book on all the different setups, the ones that just have high return on capital, the ones that just are the low valuation, and then the magic formula, which is a combination of the two. The trouble with picking high return on capital businesses as a basket generally is that the return on invested capital for most companies seems to be quite heavily mean reverting. In other words, if a company has a very high return on invested capital or a very low return on invested capital for that matter, better. As a basket of companies, in each of those positions at least, they tend to come back to more normal corporate returns on capital over time. It's very rare businesses that can actually sustain high returns on capital. Not to say they don't exist, they clearly do, but they're rare. So I would be cautious of that mean reversion, I guess, if you were to do a bit of a basket bet like that. But good question. I think Toby Carlisle will answer that one a lot better than me. Next one is from Nicholas. I thought Alibaba and Meta Platforms were screaming buys much higher than this. Who was the dumb one, me or Mr. Market? I don't have a great answer for you on that one. Sorry, Nicholas. Let's give it 5 or 10 years and we should know the answer a lot more clearly. Next one is from Mert. When a company takes on debt, does it go into free cash flow? So on a lot of websites, you'll see two different free cash flow numbers reported. You will see levered free cash flow and unlevered free cash flow. The levered free cash flow, I believe, includes or is sort of the free cash flow after all the debt servicing costs, and the unlevered free cash flow is not. So, not sure if that's exactly what you were getting at. If you're saying like, if a company takes out $1 million in new debt, does that create $1 million in free cash flow? I don't believe that's the case, because that would be involved in like the cash from investments change as opposed to cash from operations, and they're looking at capital expenditure. So hopefully that answers your question. I mean, if you just look through a cash flow statement for a company that's taken on debt, you should hopefully be able to answer that, but I think that's kind of how it's working. Next one is from Jack Potter. What's your take on China stocks? The market seems to be panicking due to Xi's party now primarily concentrated loyalists. However, they seem to be wanting to open up, support private equity markets, and respecting private enterprise. Further, I'm a shareholder of Alibaba, and I think the CCP wouldn't want to hurt a company that creates so much value for small to medium size enterprises. Therefore, I think Alibaba will be a big part of increasing the size of the middle class in China. I think there is an enormous amount of noise in this particular space. I think everyone wants to have an argument about politics when you start talking about investing in Chinese stocks, and everyone gets exceptionally macro. And I think one of the most important ideas in investing that I ever learned is that there's really two things that will matter when you make an investment. There tends to be elements of the investment case and things that are relevant to a business that are knowable and important, and there's also things that are unknowable but still important. And the things that you're getting at here with the CCP and so on, those are things that are important, but they're not knowable. I don't believe that anyone on the planet, except maybe Xi Jinping and some of his best mates, know exactly what's going to happen there. So I would say if you are interested in investing in some of those businesses, you have to keep some of the potential risks in mind. The prices are obviously getting super beat up, so you can make a pretty strong argument with a lot of those companies that they're potentially very undervalued, but do your own work on that. So that would imply that you are potentially getting paid to take that risk, but I think you've got to just allocate a portion of your portfolio appropriately for your risk tolerance based on the unknowable risks that are out there. And once you're over that hurdle, I think you just focus on the business like any other stock. So there's a huge amount of noise in that area, and I think most people are best to ignore the vast majority of it. That's kind of what I think. Next question here is from Sten Hemming. How do you think about margin, or margins? That must mean when buying a business, do you want high margins or low margins so it can increase over time? I think that the typical answer to a question like this would be the higher margins would be better, because then if you go from a 20% margin and then in a bad year you go to a 15% margin, that's a lower drop than going from a 3% to a 1% margin. That's going to be a much more significant impact to your profitability. But it really depends on the business model, and I think the more important thing is probably the stability of margins as opposed to the absolute level of margins. So, a business like Apple or Microsoft, for example, has quite high margins and they're clearly great businesses, and then a company like Costco has very low margins and they're also a very good business, and they're just different business models structured in different ways. I would be more concerned about massive volatility in margins than I would be about the absolute level per se. So hope that is useful. Next question here is from James. What's your favorite NZ public company? I saw this question last night actually, James, so I was having a bit of a think about it and nothing really sprung to mind, but I think the answer is probably Xero. Although they left us and they used to be listed on the NZX and they no longer are. They're listed just on the ASX now, I think. Xero is probably my favorite little New Zealand success story, and a business I'd love to own if it got to a reasonable price as well. So I think that's probably my favorite New Zealand company. Question from Zachariah. What are the main developments that could make you change your investment thesis on a specific company / holding, and how do you comprehensively determine whether the thesis has in fact changed? So in my investment checklist, and I've got a video on the channel, or a couple of videos going through the investment checklist that I personally use. Different people should have different investment checklists, because I'll pick up things that you don't and you'll pick up things that I don't necessarily pick up. But part of that checklist for me is, can I name the different key performance indicators they'll allow me to monitor whether a business is on track or not, and that will vary from company to company, whether it's something like Seritage Growth Property is about, how quickly are they now selling their real estate and what prices are they selling their real estate at, and is it reasonably aligned with what I thought. With a company like Thor Industries, it might be something like, how many RVs are they selling over time. They're in a quite volatile industry, so I'm not going to get too caught up in the year-to-year movements of how many RV products they sell, but I probably would pay a reasonable amount of attention to the market share, for example, because if everyone in the market's down but Thor is down more, or if everyone in the market's up and Thor's not up as much, that's gonna be the type of stuff that starts to get concerning. So it'll vary from business to business, but I would write it down before you buy your first shares, and that way you can be more rational when when bad stuff does potentially happen. Next one is from Henry. Not sure if you're a Shameless cloner or not, but my question is, if you see a couple of guru investors investing in the Pink Widget Manufacturing Co. Inc., do you A, do your own research on said company, or B, follow the crowd? I think a lot of these investors are probably actually going against the crowd, but I can definitely see the value crowd sometimes always goes in one direction. So I'll definitely be doing my own research and trying to remain patient if I can. Okay, let's take a couple more questions here. We've got one from John. What are your powerlifting PRs? Sure, I haven't competed in powerlifting since 2018, so I'm pretty washed up at this point, but my best competition lifts were 265 kilo squat, 157.5 kilo bench, and a 280 kilo deadlift. That's all in IPF affiliated competitions, if you know what that means, and in the under 105 kilogram weight class. So those are some of my old numbers. I think I've overlaid some videos on previous Q&As of some of those lifts, but that's where I'm at. Okay, let's do one last question. This one's from Tim. Hey Tom, how has the strengthening of the US dollar affected your investment thesis in US listed companies? Are you hedging against the currency risk? No, I have no currency hedges at all. I actually discussed this a little bit with Jason on from the After Dinner Investor on his podcast maybe a week ago. And it kind of sucks. Like, US stocks are going down. When I look at the value of those stocks in New Zealand dollars, it doesn't look anywhere near as bad, because the New Zealand dollar is a lot weaker against the US dollar this year. So I guess a lot of people view it as like a bit of a natural hedge. When there's kind of macro chaos, the US dollar tends to do pretty well, and it's a bit of a hedge for your US stocks and so on. But it makes it really annoying when I want to deploy cash in the US, because my New Zealand dollars don't go as far. So I don't know that I've changed anything too significantly just yet, but it is something that I'm keeping an eye on. Something I'm kind of got in the back of my mind is I feel like I'm probably more willing to sell something in the US that I own to buy something else in the US, so that there's no like foreign currency move required there. There's no requirement for me to send New Zealand dollars to US dollars. But I mean, still, like at a certain point, prices get so extreme for some of these companies that even if the currency, moves against you maybe over the next few years, you can still get a reasonable result. So yeah, it's kind of annoying. I would sort of prefer that at the same time US stocks went down, the US dollar went down, and my New Zealand dollars had a bunch more buying power as well. But unfortunately, that's just not the way the world works. So good question though. Thank you for that one, Tim. And let's call it there. We've been going for 20 minutes or so. So thank you for all your questions. I try to make this sort of a monthly occurrence, a little bit more of a casual video, just to kind of run through what's on everyone's mind and give you some off the top of the head answers. So I hope you enjoyed it. If you did, please subscribe to the channel. But that's it from me for this one, and I'll see you on the next video. Cheers.